Good morning, everyone. Today is October 8th, Thursday. I'm going to talk about the bank reconciliation. Okay, so some of you may have not learned about how to do a bank reconciliation. So here I'm just going to show you what does the bank reconciliation mean. Okay, so basically, the accountant, the bookkeeper for the company will make transactions whenever they receive cash or whenever they use cash, right? So if they receive cash, they are going to debit cash. If they use cash, they are going to credit cash, okay? So, and then what happened is that they are, most case, they should have a bank account, right? They will not keep all the cash on hand, right? It's not safe to keep all the cash inside the company or in your house, right? You want save the cash, deposit the cash to the bank. Okay, so and every month you are going to receive a bank statement, right? Showing you the balance of your account, right? So now you want to know that this balance, these two balance should agree with each other, right? So based on the bookkeeper, you have this much cash. And now what about the bank, right? So then you take a look at the bank statement, you see the balance you have for the cash account in the bank. So these two numbers should agree with each other, right? But however, in the real life, where in most of the situation, it's most likely that these two balance, according to the bookkeeper versus according to the bank, these two balances does not agree with each other. Okay, why? I'm going to show you why. Okay, so then we have to do a bank reconciliation to figure out what is the correct cash balance. Okay, that you are going to report on a financial statement. Okay, so here I'm going to show you use some simple scenarios to show you what is the reason for the discrepancies between the two balances. Okay, so on this slide, I put the two entities side by side, the company's bookkeeping versus the bank. So I put them side by side. Okay, I use the kind of like the yellowish, the bluish, greenish color for the bookkeeping record, and for the kind of the gray dark color for the bank record. Okay, and the year end in this scenario is supposed to be December 31st. Okay, so suppose on December 28th, okay, on December 28th, the bookkeeper received cash from customer. Okay, so the bookkeeper will make this entry, right? The bookkeeper will debit cash for $100. Okay, suppose the bookkeeper received $100 cash on December 28th. Okay, so bookkeeper received this money, $100. Okay, now because of the new year, right? This is the year end because of the new year. So the bookkeeper, instead of deposit this cash to the bank right away, the bookkeeper keep this $100 in the safe, okay? And she was very busy until January 1st, okay? She finally got the time, so she deposited this $100 cash to the bank, okay? So what happened is, as soon as the bookkeeper received the cash, December 28th, the bookkeeper made the entry, debit the cash for $100. So your cash balance increased by 100 according to the bookkeeper, right? According to your book. However, this cash was not deposited to bank immediately, right? It was kept in the safe for a couple of days, and it was picked up after year end on January 1st. So you can see that on January 1st, okay, when you deposit the $100 cash to the bank, and this record shows in the bank, okay? Okay, the record shows the cash increased by $100 on January 1st. According to the bookkeeping record, the cash increased by $100 on December 28th. Now you can see the timing difference, right? The timing difference, okay? So this is considered, okay, as a deposit in transit, okay? So the company did not have time to deposit this money yet. So this is a deposit in transit as of year end, okay? Now, look at another scenario. Suppose the next day, December 29th, okay, the bookkeeper write me a check, okay, $50. So just to pay me, okay, to pay my wage, right, pay my salary, okay? So I received a check from this company, from the bookkeeper, for $50. The moment the bookkeeper gave this check to me, well, the bookkeeper need to recognize this transaction by credit cash for $50, okay? So on December 29th, the cash balance decreased by $50 according to the book, right? But guess what? I don't have time to go to bank, right? So I make sure I keep my deposit in my wallet, okay? But I was really busy with this job. I didn't get time to go to bank to deposit my check until January 5th, okay? Finally, okay, after all the New Year's celebration, okay, finally I got my time, and then I remember, oh yeah, I still have this check, you know, from this company I needed to deposit. So January 5th, I showed up in the bank and I deposited this check, and so my bank balance increased $50, and for the company, the $50 cash out, right? So the cash was $50 was from this company to bank account to my account. So therefore, on January 15th, from the company's perspective, there's a cash out of $50. Okay. So in this transaction, you can see that on December 29th, according to the book, the cash decreased by 50. Okay, but nothing happened to the bank. Okay, on January 5th, okay, when this check was deposited, okay, the $50 cash is out. Okay, again, you see the timing difference. So as of the year end, December 31st, this check is considered as outstanding check. So this is a check has been written to the suppliers, but has not been deposited by the suppliers. Okay, so that's called an outstanding check. Okay. Now, suppose December 30th, okay, interest charge. So the bank charged this company interest on December 30th. That's like $10, suppose, for the monthly fee, okay? But guess what? Maybe the bookkeeper was not on job, right? Maybe the bookkeeper was sick. So the bookkeeper did not check this bank statement transaction. The bookkeeper didn't know that this is the amount of interest has been charged by the bank until January 2nd, when the bookkeeper returned to work. She checked the bank statement. She realized there is a bank fee charge of $10. So the bookkeeper will credit cash for $10. Okay, so from the bank's perspective, there is a cash balance decrease for $10 on December 31st. And this decrease was not picked up until after year end on January 2nd. Okay. Again, you see the timing difference? can happen either way, right? From both sides. So now, at the year end, according to this book, what is your cash balance? At the year end, December 31st, according to the book, okay? So I have a cash increase 100, a decrease 50. So according to this book, the balance of the cash should be 50, 100 minus 50. Okay. What about the bank? Okay, according to bank, the only transaction is a cash decrease $10. Okay, before the year end. So according to bank, the cash balance should be negative 10. Okay, so according to the book, my cash balance should be 100 minus 50, so that should be 50. But according to the bank, the balance should be negative 10. Okay, so you see these two numbers does not agree with each other. Does not agree with each other. Therefore, we have to do a bank reconciliation. So in this case, which balance is right? Right? 50 is correct or minus 10 is correct? Which balance is correct? The answer is no balance is correct. Okay, neither of the balance is correct in this case. Okay, so what is the correct balance? Okay, what is correct balance? So let's first make adjustment on the book record, left side. So the interest charge should have been picked up on December 30th, but it was not realized until January 2nd. So the bookkeeping record has to consider this cash out, right? Interest charge. So we're gonna use 100 minus 50 and also minus 10, okay? So when I fix my book record, my balance should be 40, Now, when I'm dealing with the bank, okay, it starts with negative 10. I have to add deposit in transit. So this $100 is a deposit in transit. And I also have to subtract outstanding check. So this $50 check issued to me is the outstanding check. Okay, so you have to add deposit in transit and minus outstanding check. So you add 100, you minus 50, and then that's 50. The opening is negative 10. So you ended up with 40. Okay, so your true cash balance is $40. Your true cash balance is $40. Well, I hope I'm using these very simple examples to make it clear why do we need bank reconciliation and how we're gonna do it. Okay, how we're gonna do it. Okay, so basically, you first prepare the correct balance. Okay, make adjustment to the book record to get the correct balance, and then you fix your bank record to get the correct balance, and the correct balance from both sides should equal. Okay, then you achieve the bank reconciliation. Well, I hope you enjoyed this video. Have a nice day.